is that right? So please, make an effort to work on that case. It's due on June 14th, which is the end of this Sunday. Okay, I haven't heard from anybody about, usually when it comes to the time it's due, I usually hear from many students asking me questions, but I guess this time maybe the case is very explicit or direct or something, but if you haven't had a chance to start working on it, I would suggest that you do, because it's gonna take you a little bit of time to wrap up that assignment. This time, I actually included in this assignment some data analytics type questions as well, so you may need to, I think the first assignment, there is a data analytics issue to do with warranties, I believe. So you can take a look at them as well. Okay? Now remember the formality of case writing, right? I would definitely, if this is the way I would like you to write for the exam as well. Every time when we give you a case, you have to address a brief situation analysis, which includes your role, the users, the stakeholders, who are the stakeholders and what are their preferences. And then you also need to address the constraints, right? Those are the three things you need to do. And when you're addressing the financial accounting issue, I would like you to identify, you need to use this approach, right? What we call the IGAR approach. Remember this? I think I briefly talked to you earlier. I stands for issues, G stands for gap, A stands for analysis and recommendation. So what that means is that then you need to identify the issues. So as an example, I'm just going to do something that might be a little bit easier for you, maybe from CO1. If this issue is to do with revenue recognition, so you can identify this is a revenue recognition issue, and then you need to link to the handbook. Let's say IFRS 15 or something, whatever, and whichever the section in the handbook that may be relevant to the issue that you need to address, and then you need to link that issue to that gap and analyze to explain why is it an issue, what are the implications of that issue. Then you need to make a recommendation based on whatever that's in the handbook, and then come up with a final recommendation. When you finalize the recommendation, please make sure that you also tie back to the stakeholder preferences and also the constraint. Okay, now one of the constraints could be to do with a bank covenant, like bank debt to equity ratio or current ratio. If that's the case, then you would have to address how is this issue affecting that constraint. Now, if the ratio is a concern, at the very end of the case writing, you should have a conclusion that gives the audience an overview as to what the implication of all the issues you've addressed is to that ratio. So you need to have a conclusion. I would suggest in many cases, when you're writing the management of the financial accounting case, you should have a conclusion at the end. If there are 4 or 5 financial reporting issues that we give you, then at the very end, you should have like a conclusion to see how the aggregate of these 5 or 4 or 5 issues is affecting the debt to equity ratio or cap or current ratio, whatever the ratios that we ask you to comply. Are you okay? Do you understand the format? When we talk 14.1, that's the structure I will ask you to do, and when you write the midterm or the final exam, when I give you the case, that's the way I would expect you to write as well. I think that will be the same way I'm pretty sure Professor Ponfan would have taught you earlier, so you need to follow the same way. Is it okay? Everybody's okay? I posted the first case when we discussed about contingencies, and I gave you the formality and structure, which is following IGR approach. So follow that same approach, right? Because the take-home cases, I expect more because you have a little more time and you do have access to the handbook. So that means that you should be able to make references to all the proper section in the handbook, right? Is everybody okay? Do you have any questions about the assignment? Okay, so good luck with the assignment. I think that the reason that I wanted to be due the end of this week, so hopefully you can get some feedback before you go to the midterm exam, so this way you can gauge as well. It's an individual assignment, so every one of you need to submit individually. Okay, that's one thing. Okay, last week we did talk about the pension, just very quickly revisiting the concept. Pension is a benefit that usually the company provides to the employee. The benefit is definitely after their retirement, so this way, hopefully after retirement, the employees will still be getting compensated based on the pension plan. So pension plan is a post-retirement type of benefit that they offer to the employees. Now technically speaking, there are 2 types of pension plan. One is what we call a defined benefit, and one is what we call a defined contribution plan. In today's environment, the common plan that you will all be experiencing, that when you go to the workforce, if the company does have a pension plan, it will all be defined contribution plan. Basically, on a defined contribution plan, what the employer is doing is that they would guarantee you their contribution. That's all they guarantee you. So they would give you the money, and then you go ahead and then try to find different investments that you wanted to do with that money they gave you. Most of the time, they will connect you with a trustee that you can actually select your own investment portfolio, and then you can go from there. Is it okay? So when you have the defined contribution plan, from the company perspective, because that's the only thing they need to commit to you, so your entry is very simple. You just debit pension expense, whatever, based on whatever amount they contribute you, and you credit cash. That's the end of it. Because their responsibility stops by the moment they give you the money. That's it. They don't care about how you do with that money or what the performance of that portfolio you do. It doesn't really matter to them. Are you okay? Do you understand defined contribution plan? I'm pretty sure that if you do have a pension plan in the future offered by the company, it would all be defined contribution because it has the least obligation from their perspective. Now, many times, but when you join like a government or something, that you could potentially be grandfathered for a defined benefit plan. If you do have this, then maybe you shouldn't be leaving the company. You should just stick there forever. I'm just joking. I'm not sure that's actually realistic, but now, the reason why I think the defined benefit plan is attractive is because the company is guaranteeing you the benefit you'll be getting at the time of retirement. So that's a really huge commitment, right? If you think about it, many times, by the time you started working, let's say, as I always say, you started working probably around 22, 23 years old. And then hypothetically speaking, if you work for the company forever, so you would be until you retire. That you're talking about from the age of 23 to at least around the age of 65. There's no mandatory retirement age today, so maybe you can even work to 70 or whatever you wanted to do. That duration, right? And they need to guarantee you when you join a company at year 23, they need to guarantee you the benefit you're going to get at the age of 65. So they guarantee you what's going to happen to you 40 years later. That's a huge commitment, right? But definitely many variables would happen when you define what the benefit is, because then they have to look at your age. They don't again, pension because it deals with how long you can live after your retirement until the moment you die. So everybody's different, right? So you don't know how long that period will be. That's another uncertainty. They don't know what the economic conditions is go over that 40 years, because then if a lot of issues like today, right? The stock market is not so bad at this point in time, but it can be very volatile, right? So you can go through many different rough times in that 40-year period, and that could have an impact to your portfolio, as an example. Again, so that could be one factor that you need to consider. It can also depend on what is the position you're holding. When you're retiring, if you're holding senior management, you might be getting additional benefits. If you're holding just a regular position, then you might be getting certain salary level. All these factors, right, would be affecting your final payout that they need to do. So defined benefit plan is a lot more obligation the company would have to commit to you, right? Relative to the defined contribution plan. And defined benefit plan is actually quite complicated, right? Because of that reason. Now, so many times when you have a defined benefit plan, the company first of all have to work with the trustee. The trustee will actually manage the plan for them, right? Now, there are two components, as I mentioned with you last week, that you would have to always try to reconcile. One is what we call the, if I can find a defined benefit obligation. And the other one is the pension plan assets. You always have to balance these two things as you go. Now, defined benefit obligation is basically saying that what is their obligation to you on the day of your retirement, okay? So this is the obligation they need to pay out on the day of your retirement based on the years of service that you have and all the other changes in the pension plan over the years when you're working with them. Plan assets is when they put the money into the plan and they have to take a look at how that plan would yield, right, as a return in the future. Are you okay? In the ideal situation, you want to make sure that these two numbers are equal, because then you have enough money. Plan assets is the money that you will cover the payout later on. So you have to make sure that those of them are equal. But the reality is, in many cases, you always will have a deficit because of the fact that Many times the company just does not have enough money to contribute to the plan, and as a result of that, most of the time you have a deficit. Now, many times when you take a look at these union negotiations, the argument and so on, one of the issues is to do with pension plan. Because the company just does not have enough money to top up the pension plan, then many times they would have to negotiate with the union to try to bring down the benefits of the plan, right? So they would be able to manage in that regard. Now, pension plan is all highly legislated, meaning that the company would have an obligation to top up the plan on a fairly regular basis, right? You can't just keep on just delaying the top up. You would have to top up, as frequently as you can. But then the issue is that then if you don't have enough money, then you would have to negotiate with the employees to try to bring down the plan somewhat, right? That would affect all the obligation. So in high level, do you understand the concept here? Now, I gave you a list last week in my Excel sheets about the item that will flow through the pension obligation. So I just want to very quickly take a look at it. The most common thing is the current service cost. And the other thing is the past service cost. Now, what are these costs? Why would that affect the obligation? Every year you work, it means something to the obligation, right? The longer you work, the more the obligation the company has to you. Because the pension is all depending on your work, how long you work for the company. So the longer you work, the more the obligation. So every year, they figure out that what is that, for every employee, they need to figure out what is the pension obligation they have to the employee based on every year's worth of service that they work for you. So that's what we call current service cost. So what is the pension obligation based on the current year of service that they need to add to the obligation in the pool? So pension, whenever you talk about current service cost, that cost increases your obligation. Are you okay? Okay? Now, past service cost basically means that every time before the pension plan gets implemented, there are a lot of employees that may not be, that will not be actually added into the pension plan until they get implemented, which means that a lot of times companies may not implement the pension plan maybe until 10 or 20 years after they're in business. So that means that the employee that are joining you from day one, they'll be missing out that 20 years of service. So remember, every single year you work, technically speaking, adds to the obligation. But because the pension plan did not get started until 20 years later, that means that every employee is missing out the first 20 years of service. And that means a lot, right, when it comes to the obligation. Now, some companies, if they're in a really good financial position and they really care about the employees, they might go back and top up for those employees that were actually there before the pension plan gets initiated. So what that means is that they would put money into what they call the past service cost. Okay, and what they call the past service cost. So past service cost, if the company initiated this, that means this will also add to the obligation as well, right? That makes sense? Now, obligation is basically a liability, and as a liability, you always have to account for the interest. So we always have the interest for these obligations that would add to this pension obligation. Everybody's okay? Now, many times, the other thing, you have to have changes to the plan. Now, what do I mean by changes to the plan? That would be adding or decreasing the pension obligation. What are these changes? Now, many times that, as I mentioned to you, that you may be negotiating with the union, right? The union might say, okay, because the company does not have the money to top up the plan, they would talk to the union and say, would you be able to reduce the obligation the company is obligated to pay out? If they agree with this, then that means you are changing the scope of the pension plan, then you have to reduce the obligation, right? If they agree to reduce. Okay, so that would be a negotiation thing. Now, many times that, as you can see in today's environment, companies go through many restructuring as well. Now, when they restructure, a couple of things could happen. If they restructure, including selling the business to somebody else, that means some employees may go with the sale, right? And that means the pension plan will go with them as well. That means you got to pay out these pension plan when that happens. So that means that there will be reducing the obligation because you're paying them out, and then your assets will also go down at the same time because you're using the money to pay them out. That could be one thing. Or if the employees get retired or they get terminated, then you got to clean up their pension plan as well. If that's the case, then that means the obligation will go down because you're paying them out. So either way, right, when you're doing any change, so the change can happen in many different ways. It can happen because they have an arrangement with the employees to reduce or increase the pension obligation. If that's what they do, you either increase or decrease it depending on what the arrangement is. Or if you have some aspect of restructuring where employees would have to be terminated, or employees may have to go with the divestment of the business, then if that's the case, that means the pension would be paying out, and that would be reducing or increase. In that case, we'll be reducing the obligation in that regard. But something can happen too, right? You can buy another company, and then your pension plan will be increased because you are absorbing the pension from the other company for the employees that will come with the acquisition, right? That could also happen. Is it okay? So you need to understand what that is? So that could be one thing. Definitely, the other thing that would affect this is the payment to the retirees. Because the retirees would get paid out, so that when they pay out, they would come down from here, and they will also come up from here. Now, the final thing I want to talk about here is what we call the actuarial revaluation. So what happened is that then, because you're working with a trustee, periodically speaking, they will reevaluate your pension obligation based on the employee's years of service, based on their age, based on the position they're working on, based on the economic conditions, like based on all these different factors. They will reassess what the total pension obligation should be. Then whenever they do those revaluations, right, your pension obligation can go up or go down. Okay, so you need to make the adjustments to reflect what the revaluation actually means. Is it okay? So everybody understands the concept? So I would go through some examples with you how those things all fit in, but these are the elements, the common elements that would affect your defined benefit obligation, right? Is everybody okay? Now, plan assets is usually one of the key thing about plan assets is the contribution by the company. Whenever the company actually contributes money, they would actually put in their plan assets, right? Now, the other thing is definitely you can have the expected return of the assets. So it's contribution, the expected return, and any changes to the pension plan. The same changes that we talk about here. Now, IFRS requires you that when you calculate the expected return here, and also the interest calculation, you must use the same interest rate. You have to use the same interest rate on both sides. Now, those are usually based on the more stable instrument, the return on the most stable instruments, such as like bonds, like government bonds and those kind of things, or treasury bills or things of that nature. You would usually use those as a benchmark to come up with those interest rates. Is that okay? That's one thing I would like you to understand. Do you have an idea about what we're talking about here so far? I would like to go through the example, but one other thing I want to talk to you about, what you needed to be cautious about. Depending on when the changes happen, that would affect your interest calculation, right? Now, so normally interest is calculated based on the timing these elements are in the plan. So as an example, you always have an opening balance. The opening balance would be subject to interest for the whole year, right? Because you start in the beginning of the year, you would be ending for the rest of the year. You're assuming that that opening balance stays all the way through. So opening balance will always capture interest calculated for the whole 12 months. But then all these other things that could happen. Current service costs are usually provided to you at the end of a service, so that means it will be given to you at the end of the year. So current service costs usually would not attract any interest if that's the case. Because it's just going to be at the end of the year. Next year, this current service will attract interest, but if the current service costs are only paid out at the end of the year, that current service cost does not attract any interest at all. Past service costs are usually given to you at the beginning of the year, so normally speaking, unless they state otherwise, then past service costs usually would attract the full year interest. What I'm trying to say to you is that anytime that there are any changes to the benefit obligation, you have to take a look at what is the timing that happened. If anything, let's say as an example, if the payment to the retirees are happening every June, okay, it would attract interest for 6 months if that's the case. Are you okay? Because then the change is happening in the middle of the year. That means for the remaining of the year, they will be attracting the interest, right? So you have to take a look at when the changes take place. Is that taking place at the beginning of the year, partway through the year, or at the end of the year? Anything that's happening at the beginning of the year or partway through the year, they'll be subject to the interest calculation, depending on when they change. But if they're happening at the end of the year, they won't attract any interest, right? Be careful about this. One other thing, I keep on saying this to my students, but every time when I put this in an exam, majority of students didn't pick it up. When you have a payment that's actually equally paid throughout the year, okay, so let's say the payment to retirees, every period you would be paying, if I say that there's $20,000 that's the payment to the retirees, but the payment is given to the employee basically equally every single month, right? The same amount every single month. Then when you calculate the interest, you only take a half year impact to average it out, right? Okay, understand what I'm saying? So any kind of changes that are actually even throughout the year. So if the payment, the cash flow is given out, or you're coming in equally every single month on the same amount, even though they give you like a full amount, but then what they tell you, the pattern of the change is equal every single period. Then when you calculate the interest, that instrument should only capture 50% of the impact, because we're trying to average it out. So please make a note so you understand that if I say to you the payment to the retirees is actually paid to the retirees basically every month on an every monthly basis, even though the amount is for the full year, then when you calculate the interest, you only take half of that amount to calculate the interest. Do you follow what I'm trying to say? Do you have any questions? Now we have the expected return, right? The expected return calculation is similar to this. If the contribution is made at the beginning of the year, you will attract the full year interest. If the contribution is made at the end of the year, it will not attract any interest. If contribution is made in June, then you will attract 6 months interest, right? You have to figure out when the change happened, and that's the timing you need to account for the interest calculation. Is everybody clear about what I'm saying? All right. Now don't forget, one other thing you need to do when it comes to this pension plan, you always have to compare the expected return to the actual return, right? So you have what we call the experience gain or losses. This is comparing the actual return to the expected return. This has to be added into your pension plan, into your plan assets at the end of the period as well. Because you always have to compare the expected return to the actual return and adjust it for the difference. And that difference is what we call the experience return. Now, why is it important for me to segregate this? Now, from the ASPE perspective, there's no OCI, so everything that you funnel through the obligation, if anything increases the obligation, it's an expense, right? So you would debit the pension expense and crediting the account. Now, when you're making the journal entry, anything that increases the benefit obligation, you would debit the pension expense, and you would credit an account called the net defined benefit. I'm putting rough words here because I'm going to go through an example with you later on, but just maybe make a note. This is the generic account called defined benefit asset liability account. This is a holding account. So you would debit pension expense and crediting this account on anything that increases the obligation, right? You would expense them and credit to this account. This is not journal entry, this is just a reconciliation, but then you have to journalize anything that goes through this reconciliation into your books, right? This reconciliation is provided to you by the trustee. At the end of every year, the trustee will provide you with this schedule, and then you would take this schedule, and then you would need to include this as one of the disclosure into your financial statement. But then on the other hand, you also have to record any changes into your financial statements, and the recording would be related to any increases to the defined benefit obligation, except for the actuarial revaluation. Anything else? I'm sorry, no, okay, I'm talking about ASPE. ASPE is everything, every changes you go through into the defined benefit obligation. If they are increasing the obligation, you would debit the pension expense and credit to this account. Are we clear? If anything, reducing the obligation, it will be the reverse of this entry. you will be debiting the defined benefit obligation and then you credit the pension expense. Are you okay? When it comes to the pension plan assets, anything that, except for contribution, if for contribution, you'll be debiting this account and crediting cash, because you'll be paying out cash, but then you'll be debiting to this account, because it's a holding account, right? But then for anything that's going to increase your pension assets outside of contribution, you would be crediting pension expense and debiting this account, because that would be reducing your cost, right, in that regard. That's SB. SB, everything flows through your pension expense. Is it okay? Either debit or credit. Now, under IFRS, that's tricky because everything, you do the same thing except for anything to do with what we call the reevaluation differences, anything to do with revaluation, you would then need to take it to OCI. So in this case, what is the revaluation? The revaluation would be the actuarial reevaluation that would need to go to OCI. And then experience gain or losses have to go to the OCI as well, because those are all regarded as reevaluation of the pension plan. Do you follow? So those are the only two items under IFRS would have to go through OCI, everything else would go through to your pension expense. But SB, everything goes through your pension expense, right? Do you understand the concept? Do you have any questions? Couple other things I want you to know is that then the other thing is that on a regular basis, you need to take a look if your plan is over or underfunded. So you always need to compare the opening balance or the ending balance of the defined benefit obligation and the pension and the plan assets to see if you're over or underfunded status. When my defined benefit obligation is higher than the plan assets, am I over or underfunded? If my obligation is higher, am I over or underfunded? Under, right? Underfunded. If my obligation is lower, that means plan assets is higher, that means I'm overfunded. You want to be always in the overfunded position, although in reality, majority of the time it's the other way around, right? Now, one other thing is any over or underfunded balance, when you compare the two, the difference would always be equal to, please make a note of this, any over or underfunded amounts should always be equal to the total balance of this account, net defined benefit asset liability account. They should always be the same. Okay, so any over or underfunded amounts for the pension plan, they should always be equal to the net defined benefit asset liability account, the balance of that account. So you can, many times when I ask you to do a reconciliation, and if I don't give you any opening balance, then as long as you know whether the opening balance of these two accounts, whether they're over or underfunded or the opening balance, you can use that amount as a start as the opening balance of this account, right? Because it should be the same. Is everything okay? Do you have any questions? The pension plan chapter sounds challenging, but it's actually pretty straightforward once you understand the logistics of it. In the exam, if I give you a question on pension, please make sure you don't lose any marks, although majority of the time, students lose a lot of marks, I don't know why. But it's actually really, really quite straightforward. So please make sure you fully understand the concept. Okay, I'm gonna go over question number 1 with you in the supplementary question. Everybody assigned this classes? Okay. Okay, can we take a look at question number 1? Yeah, you have a question? Oh, okay. I'm trying to find my question number 1 here. Right here. Okay, so can we? Okay. Okay, so the question basically tell you that they have a defined benefit obligation January 1st, 2025, and they give you the opening balance of the planned assets as well. They give you the different components. The very end, they tell you what is the defined benefit obligation at the end of 2025. So that's fill in the blanks. So they give you the opening balance of the defined benefit obligation, which in this case is 1970. And then for the planned assets, the opening balance is 1860, right? So far so good, is everybody okay? Do you have any questions? Do you have any questions? Okay, now then, the current service cost, they tell you it's 163, where would they go? The current service costs always go into your defined benefit obligation. In the exam, you won't be given these templates, you would have to know your templates directly, you would have to come up with your own schedule. So please make sure you know where all the different items go, right? So your current service cost in this case is gonna be 163,000. So that would go into your pension obligation. They tell you the actual return is 201,000. We don't include the actual return into the schedule, but we do need the actual return to calculate your experience gain or losses. So I'm gonna put it down here for the actual return, which is 201,000. That's what you need, okay? You don't need to put that in the schedule, but you do need to use that to calculate your experience gain or losses, right? So that's why I'm gonna put it down here, just for the calculation here. And then they tell you that the annual contribution to the plan, the annual contribution to the plan is actually here. The contribution is done on June 1st, so that means what? That means when you do the interest calculation, you have to count how much of the interest? 7 months, right? You have to count for 7 months of that interest, right? Because it's initiated in June 1st. Do you follow? Okay, so the amount here is 216,000, right? Then they pay the retirees of 14,400, okay? So that would be happening in both sides. And when are they paying out, did they say? They did tell you that the payment to the retirees is on December 31st. That means that these will not attract any interest calculation, right? Because that's the end of the year. And then they tell you that at the end of the year, they have a reduction in the DPO for 177. That's a reduction. And then on the other hand, that reduction also, the planned assets is also transferred to the employee because they terminated. They probably have some restructuring, which they terminated some employees. They paid out $200,000 to the employees. So that means that you need to minus $200,000 here under your planned assets, but they also reduced the obligation by 177. Do you understand what they said in the question? Do you understand what we're doing here? Do you have any questions? Do you have any questions? Do you understand what we're doing? And this is done at the end of the year, so these changes will not affect any interest calculation, right? Then the only thing left is to calculate the interest. If you take a look at all the changes in the obligation, none of these actually attract any interest except for the opening balance. So I just need to take 1,970,000 multiplied by 7%. How do I come with 7%? They did tell you that discount rate assumption yield on corporate bonds is 7%. So that's why I'm going to use 7% here. So my interest is 137,900. It's only applying to the opening balance. Do you follow? Do you understand the concept? Are you okay?
So if the service cost was happening January 1st, then you have to also apply that.
Yes. Or if they happen in June, then you have to apply for 6 months, right? If they happen in July, I'm sorry, then you have to account for 6 months.
Every single one of those are
Every single changes, you've got to figure out when that change happens.
okay.
If that change has happened at the beginning of the year, that would attract interest. Anytime during the year, they will also attract interest, but partially, but then at the end of the year, they won't attract any interest, right? Because that's only happened at the end of the year. Any changes that go through? Do you follow? You okay? Alright. Now, one other thing I want to talk to you, we need to make journal entries again for any changes. The only change we do not make any journal entries is benefit paid to retirees. Why? Why do I not need to make any journal entry here? Why? Any changes you make, you have to make a journal entry, but why do I not make a journal entry on retiree benefit paid to the retirees? Because it goes in one pocket, it goes out the other pocket, right? You're reducing the obligation, the reduction of the obligation is gonna help you to reduce the assets. It goes in and out of that account, it washes out from each other, so that's the reason why we don't make a journal entry for it. Are you okay? Do you have any questions? Make sure you understand what we're doing. So we do not need to make any journal entry regarding the benefits paid to the retirees if they're the same amount, which in this case they are. Then the reason for that is in and out of the entry, and you don't need to make it. But all the other changes you have to make a journal entry for. Okay, so we did calculate the interest expense. Now, they did also tell you what the ending balance of the account is. The ending balance of the defined benefit obligation is 2 million, I think, and $115,000. So that's my ending balance. So what do you think the difference is? The difference is your actuarial gain or losses, right? Am I getting better or worse?
That's worse.
I'm getting worse, so that means you have a loss, right? So you have an actuarial loss in this case, so because it's worse. So in that case, you would take 2,115 minus 2,079,500. So that means you have a loss of 35,500, which you would have to make a journal entry. Remember I said, this journal entry under IFRS will go to OCI, under ASPE will still go into pension expense. Is it okay? Loss meaning you're debiting the account, right? You're debiting the OCI or the pension expense. That's what loss is, it's like an expense. Do you follow the logic? Do you have any questions? I'm gonna go through the journal entry with you a little bit later, but I just wanted to, as we're going through the account, I just want to point those things out to you. Okay, so let's take a look at the experience gain or losses. In this case here, I have the opening balance, I have to account for the interest, and the contribution, I have to account for the interest also, because that's actually paid out, that's actually paid into the plan on June 1st. That means I'm attracting interest for 7 months here, right? For these two, it doesn't attract any interest because they're initiated at the end of the year, so that does not affect me. So my expected return has to be based on these two. This for the full year, this only for 7 months. So when I take a look at the calculation, I would take the opening balance multiplied by 7%. The contribution, I would still multiply by 7%, but I would need to prorate it based on 7 months only, so that's why I take 7 out of 12, right? So my total expected return is 139.20. Do you follow? Do you have any questions? Then what is the actual return? The actual return is actually 201, right? So am I better off or worse off? Is the actual higher or lower than the expected? Meaning, am I better off or worse off? Better off, that means it's a gain, right? So you have an experience gain of 61,980, so what you would add up to the planned assets. And so this is my balance. Am I over or under funded status now? At the end of the period, am I over or under? I'm underfunded. In the beginning, am I over or under? I'm also under. Now remember, as I said, these balances, right, should equal to this balances in this account. So let's prove it if that's the case. Okay, let's do the journal entries now. Now what I normally suggest you to do is, rather than doing every single change into the entry, because they all go to the same place, so you can actually create a schedule called pension expense schedule. Okay, pension expense schedule will take into account current service cost, reduction on the DBO, and also the interest, And on this side, you'll be taking care of the plan asset transfer and the expected return. Are you okay? Under IFRS, that's what you'll be taking care of. So if you take a look at the pension expense schedule, I put down the over or underfunded here, so the underfunded in the opening is 110, the ending is 52,400, which we calculated here. So I'm creating a pension expense under IFRS. I need to create this account. Anything that increases your obligation, it's a debit to the pension expense. Anything that reduces your obligation, it's a credit to the pension expense, right? Anything that's increasing the plan assets outside of contribution is going to be a credit. Anything that's reducing it is going to be a debit to the pension expense. Do you understand the logic? Do you understand the concept? Do you understand what I'm saying here? I'm just gonna repeat one more time, just to make sure when you do the journal entry, you're not missing anything out. Anytime when the changes increases the obligation, you need a debit to the pension expense because it's a cost. That's why you have an increase in obligation, right? Anytime when the obligation goes down, your cost goes down, that means it's a credit to your pension expense. On the asset side, outside of contribution, we don't count contribution in this regard, but anything else that changes the plan assets, anything that increases your plan assets is a reduction to your obligation. That means that it would be a reduction to your pension expense, but anything that's decreasing your plan assets, then that would be debiting the pension expense. So it works to reverse to the obligation. Do you follow? Are you making some notes? Are you okay? So this is what these journal entries are about. Now, the only difference is any actuarial loss, any revaluation gain or losses, which is like the actuarial loss or the experience gain, these go into your OCI. So these two accounts will go into your OCI under IFRS, but under SP, they still go against your expenses. So in this case here, you will see that this is the total pension expense, the net pension expense. It's an expense, so that means you would debit this. And SP, you'll be using 158,400. Now, so you debit the pension expense for the total, and you credit the net defined benefit asset liability account, right? Do you follow? Are you okay? Do you have any questions? So what I'm saying to you is that when you finish the reconciliation, the next step for you is to come up with a pension expense schedule, so you can account for all the items that go into the pension expense or that have an impact in the pension expense, and then you can just do one journal entry once you come up with that schedule. In the exam, please make sure that you do explicitly explain what goes into the pension expense. In the event that you make a mistake, you can still get part marks, okay? But if you don't do this, then you'll be losing, you will get 0 mark, right? Make sure you show your schedule, make sure you show your calculations. And then in the IFRS situation, anything that goes against the OCI, it increases the pension expense. That means it would be debiting the OCI. That's what the entry is. And then the experience gain, it would be offsetting the OCI, which in this case, I believe it's 61,980, right? Okay, so that's what we have. And then on the funding side, you would debit the net defined benefit asset liability account. I think it's 200,000 on the funding. How much do they contribute to the plan? 216,000, I guess. And you would credit cash, right? Because you're paying out cash. And that's the same here. Okay, so that's the journal entries, and then if I reconcile the account, so this is the opening balance of this account. I'm taking the overall under status here. I added all the accounts that flow through here. This is a credit, this is a credit, this is a debit, and this is also a debit. If you take a look at all these accounts, they will equal to that over under funded status, right? That we discussed earlier. These two accounts are tying back to the two accounts that I talked to you earlier, right? Please make sure the whole process, right? Please make sure this is everything you need to know about pension. Do we have any questions on pension? Are you okay? The funny thing is, every time when I ask that question, nobody answering the question, but when I look at the exam results, it seems like majority of class is still having issues with pension. So I encourage you to ask a lot of questions so you understand the logic.
So, just to clarify, Professor, the actuarial loss and experience gain is already in pension expense for ASPE, but it's another comprehensive income for IFRS. We have to look journal entries for that. That's why.
That's right, but then it's not automatic, right? Even in ASPE, you would have to physically include it as part of the pension expense calculation, and then you would then journalize it into the pension expense. What I'm trying to say is that, technically speaking, every change you're supposed to have a journal entry to record them. The reason we're creating a pension expense schedule is just to ease off your entries. You don't have to do it for everyone, you just take a pension expense schedule that incorporates all the items that will go through the pension expense, and then you just need to make one journal entry based on that pension expense schedule, just to make your work a little bit easier. I mean, you can still do the entries separately one by one, but it's gonna take you forever, right? So that's why I recommended that when you finish the reconciliation, if I ask you to come up with the journal entries, then do a schedule on pension expense. Then you take all the items that would be affecting the pension expense, and you make one journal entry on the pension expense. Are you okay? Do you have any questions? Okay, if you don't have any questions, I want to move on to question number 2. For question number 2, they give you 2 years. They have 2025 and 2026, and they're saying this is the first year that they actually have the pension plan, so they don't have any opening balance. They give you the funding, they give you the payment to retirees, current service costs and past service costs, and they give you the actual return. They give you what the ending balance of the defined benefit obligation is at the end of the year for both years. And they're using 6% for the first year and 5% for the second year. Are you okay? Do you have any questions about the problem, about what they tell you? Okay, so tell me what I need to do. So, so my opening balance is 0. And what's the next thing? What's my ending balance? My ending balance is, do I have the ending balance? Did they provide you with the ending balance? What's the ending balance for both years? Anybody? Please take a look at the question and try to work with me, then this way you can try to see if you understand the concept. Do we have the ending balance for the defined benefit obligation? And what are those numbers? 4 million for the first year. And what about the second year? 5.5 million, 700,000. Are you okay? These are the things you can fill in automatically. Opening balance is 0. Do I have any past service cost? 2.4 million for the first year. That's all you have. So that would that's usually, if they don't mention anything to you, you always make the assumption that past service cost is happening from the beginning of the year, because usually those are the things you want to incorporate before you run into the current year. So that'll be 2.4 million. Do I have any current service cost? What's the amount?
1.5 million.
For the first year, and what about the second year?
1.65 million.
Are you okay? And then what else did they give you? They tell you the payment to the retirees is how much? Payment to the retirees is how much? 50,000. It would appear on both the obligations. Are they saying both years, 50,000? And and then you will need to put it here as well, right? Okay, opening balance for the planners is also 0, and then how much is the funding? I think put the funding is how much?
1 million.
It's 1 million and also
1.1 million.
okay, so now we can take a look at the expected return and the interest on the DBO. Which one of these would capture the interest?
Beginning balance and
Beginning balance
pass-throughs.
and also the past service. So both of them are actually on the full amount. So the first year, I only have the past service cost, that means this would be multiplied by 6%. And then the second year, I have the opening balance, which I don't have now. Actually, the opening balance is the ending balance, so this would be 4 million, right? Okay, and then, so this way, then I need to calculate so in this case, that would be 2.4 million. So that'd be 144 here. Okay, and then the interest for the second year is based on this opening balance, but everything else is done at the end of the year. So you would take 4 million times 5%. So you get $200,000 here. Are you okay? And then we compare basically the obligation before the ending balance, and in the first year, we have the actual loss, we have the actual loss, right? Because the final obligation is higher than what we estimated here. So that's why you have an actual loss here. The second year, it seems like you have a gain of 30,000. These all go to OCI under IFRS, right? As an example. Then let's take a look at this. Then the expected return in this case only applying to the funding, because that's all we have. So you're going to take a look at $1 million times 6%. And then the actual return in this year is 100,000. So that means that you actually have a gain, right? Of $40,000, right? Because you do have a gain in this year. So that means your experience gain in this year is 40,000. And then, so this is my opening balance, this is my ending balance, and that becomes also my opening balance. And then my expected gain here, based on the funding of 1.1 million, is $55,000 because the interest rates dropped to 5%. Your actual return is 70, so that means you would have basically a gain, right, for the difference. Basically, you would have actually in this case a loss. Because the actual return is 70,000 and the expected return is actually 107,500. So you actually have a loss of $37,500. So that would be 107,500, and this would be a loss of 37,500, right? Okay, but do you understand what we're doing here? Now let's go back to take a look at it. In the expected return for the first year, I just have the funding, so that's what I needed to account for the interest. In the second year, I not only have the funding, I also have the opening balance. So my total expected return, it comes up to be 107,500. You have the actual return is only 70,000, so in the second year, you have a experienced loss, right? In the first year, your actual return is 100,000, but the expected return is only 60,000. So in that case, you actually have a gain of 640,000, and that's what is being now reflected into my schedule here. Do you have any questions? Are you okay? Then now, yeah,
What if hypothetically, is like last year the interest rate changes? Would that be under changes to the plan?
would that be what?
You know the changes to the plan is not here, right?
No, it's nothing to do with the change in the plan, it's just the interest rate changes.
Yeah.
Interest rate changes has nothing to do with the plan.
Okay.
So you just reflect that year's interest based on that new interest rate, that's
So
all.
like in mid-year, it just switches. Is that, you just account for that? Is that a separate account or just like?
What's that again, sorry?
What if the interest rate changes in the middle of the year? Can happen.
It can happen, then you would prorate it based on the timing that you have in the old rate, the time you have the new rate, right?
So it'd just be like regular interest rate, no
Yeah.
special.
No, nothing special here, yeah, just the regular interest rate that you need to cut. I don't think I'll give you those kind of questions just to trick you, but in real life, that could happen. Everybody's okay? Then, remember, we take a look at the funding and the funding status, so we take a look at it, so at the end of the year, we actually have, quite a bit of underfunded, right, is that the amount? So we have 4 million, the 5.7 million versus 2.1 million, right? This is the ending balance, this is the opening balance, this is the, ending balance for the first year. So that's what we have. And then the pension expense, these are the elements that go through. I won't go through in the details with you, but those are coming from the schedule. So these are the things that will go into your pension expense under IFRS, except for the revaluation gain or losses. So in this case, then you just make a journal entry for the total amount for each of those years, and you credit the net defined benefit asset liability account. And then all the funding, I need to debit the net defined benefit asset liability account and credit in cash. That's what I need to do, and any remeasurement gain or losses, you're going to be taking into the OCI. So in the first case, what is my total here? My first case, I do have an actual loss of 6,000 and the next year a gain of 30,000. So the first year I would debit OCI for 3,000. Actually, it should be 6,000. Let me see. Did I make a mistake here? It's 6,000, right? So I put a wrong account here. Okay, so for the next year, I have a gain, so I would debit the account for actuarial net defined benefit asset liability account and crediting the OCI for 30,000. Did you follow what I'm trying to do? Do you have any questions here? This gain is 40,000. And the loss here is 37,500. And this is the reconciliation that you can take a look at them. This is the cycle that I expected to know in pension, so please practice those questions. Next week, I'm going to take up another question with you in pension, before we move into chapter 15. And then there will be your exam. Do you have any questions about pension so far? Do you get a general idea of what's involved? Okay. Pension, as I said, is not an overly challenging question, but there's a lot to also look into. Okay, if you have any question, I would like to take a look at 14.1, exercise IC 14.1. Did everybody read the case? Has everybody read the case? Okay, I'm gonna give you 5 minutes to read the case because there's no point for me to discuss the case if you haven't read it. You look at the transaction to see if they account for the, you mean they comply to the standard, is what you're saying? Okay, that's one. Is that it?
Something about ratio.
What is the one other thing you think you need to provide advice? Go through the issues a little more thoroughly. Go to the very end of the question and tell me, is there anything else you're asked to do outside of, just outside of reviewing the accounting issues?
Make sure the ratio is within.
Okay, so outside of the ratio, is there anything else? It is the dividend, right? You have to provide an advice to see if the dividend should be distributed or not, right? That's one thing. But that kind of link into the ratio as well. So, but then you need to be specifically saying you are tasked to actually review the transactions and provide advice on the accounting treatment for all these transactions. But on the other hand, you also wanted to give them advice about whether the company should be distributing a dividend, right? Does that make sense? Are you okay? Okay. So so who are the stakeholders and what are their preferences? Let's do a couple. Let's do two. So who are the audience? I need a little bit more engagement in this. If this is the interest, then I won't take up any cases with you anymore because it's a waste of time, right? I need a little more engagement from the class. You are the ones that will be doing the cases, and I'm trying to help you to be able to write the cases properly. So please please get engaged and try to discuss to see if it's okay to make a mistake now. It's rather to make a mistake now than when you're physically writing the case in the exam. So who are the stakeholders and what are their preferences? Yeah.
Bob Brasher, he owns the company.
And then what is his preferences? What did he want?
Better looking financial statements.
Okay, better looking is kind of a little bit tricky in the wording, but definitely he did want to make sure he has an accurate financial statements, right? In that regard, anything else that he's looking for the financial statements that's important for him? There's a few things he's looking for, right? Outside of the fact that he wanted to have the financials to be compliant with the standard, is there anything else that he wants to do? Yeah.
Additional financing.
He needs additional financing. Why did he need additional financing? He's looking to expand. So his goal is to expand the business, right? That's why he needs to make sure that he's getting the financing. That's what he wants, right? Because ultimately you have to tie back, when you're making the recommendation, you have to tie back to that preference. Does it make sense? Are you okay? Okay, who are the other stakeholder? Anybody? The bank, absolutely. What are they looking for?
To equity ratio.
They need to make sure you comply to covenant, but that's not the main interest, right? What's the main interest? The bank only has one key interest. What is that interest? That's all the requirements. But what is the requirement for? Why do they need all these requirements? At the end of the day, what do they want to accomplish? Absolutely, they want to ensure that they can pay back on the loan, right? That's why to do this, they want to make sure that you are complying to the bank covenant, which is the audited financial statements and also the meeting, is a debt to equity ratio, I believe, right? They're looking for here. So that's what you need to comply. Is that okay? Okay, let's stick with those two for now, but you can also argue a third one. What would be the third one? Don't forget that the auditor in this case is also a stakeholder as well, right? Because then they have to make sure that they are complying. Their goal is to make sure you are complying to the standards, right? Because that's the key thing. Okay, what are the constraints here? There should be 2 or 3 constraints here. What are the 2 or 3 constraints? Now, whenever you talk about these things, make sure you elaborate on it because you need a depth, right? When you're writing cases, you need to have the depth. Not just shallowing, just discussing and identifying things, you're gonna go deeper. So in terms of the bank covenant, when you talk about stakeholders, you need to explain who they are, what is their preferences, and why is that important, okay? In this case here, you're talking about the constraint, so you have to explain why is that a constraint. So first of all, what is the first constraint? This is a financial reporting case right off the bat. What is the constraint? Sorry? That could be one constraint, but I'm just asking you that this is a financial reporting issue, isn't it? So what is the first constraint you should be addressing? You have to talk about the accounting standard. In this case, they ask you to look into both, but in this case, I'm going to focus on only one. So which one do you think they should be using? IFRS or SB? They're privately owned, so you can argue about SB, but the company is thinking about growth. You can also argue about IFRS, but whichever one you use, you need to stick to that principle, to those guidelines, right? But you need to explain why IFRS and why SB, right? You can say they're private. That's the reason why they are using SB. You can think the company is looking for growth. The bank is looking for audited financial statements. So IFRS may be more appropriate. Either way, you need to argue about why you think that is relevant, okay? What are the other constraints? I think you talk about the bank ratio, because that's something that's the reason it's a constraint, because that's one of the bank covenant, right? And you need to specifically, now tell me right off the bat, did they give you information to tell you where they stand right now? Go into depth. So when they tell you that there is a bank, what is the requirement? What's the equity ratio they ask you to benchmark? 1-to-1. So where are they now? You should be able to do a quick, did they give you that information? Go to the back of the case, did they tell you what their current debt and equity number is? So what is that ratio? I'm sorry, point what?
2.4 to 1 to 3.
Is that, I don't think that's a high, right?
2 to 1.
I think your bank is 1.3 million versus what?
1.3.
It's at the back of the case.
1.3 to 2.4.
Your debt is 1.3 and then your equity is 2.4, isn't it? That's before any adjustment. So what is that equal to? What is that equal to? What's 1.3 divided by 2.4? About 0.6 or something, isn't it? Okay, so basically they're still within the guideline for now. Okay, so you need to indicate that one of the constraints is the debt to equity ratio, which they're asking you to be complying is 2-to-1, I think. At the moment, the company is running at, is it 2-to-1 or 1-to-1? 1-to-1, and then you should say that at this point in time, the company's, before any kind of adjustment, the debt to equity ratio is 0.6 whatever to 1, right? So they're still within the guideline for the time being. Then you have to do the analysis to see if that's true. Is it okay? Then you say further analysis will be required to validate, to see if that debt to equity ratio is still compliant, right? But make sure you do it in depth. That's why I'm saying that you need to go further, right? In discussing it. What's the third constraint? The fact that they're looking for financing, meaning the company is also cash constrained as well, right? They do have a cash constraint in this case here, because they don't have the cash, they can't grow. Is that a problem? That could be a problem as well, right? So make sure that you also identify the company is having they need financing, and because of the fact that they want to expand and they're really cash constrained as well. Okay, so because many times when you look at the issue, then you go back. So what is the first issue then that we need to talk about here? IGAR approach, I said to you, right? So what is the issue? Yes?
Is that a warranty issue? Are they warranted?
It's a warranty issue, right? It's definitely, is that what type of warranty is that? Is it a service type or is that assurance type?
I believe it's an insurance type.
Is that assurance or is that service? Take a look at it deeply. It says that during 2023, they sold, right, 100 warranties for $5,000 each. The fact that they sell these warranties, meaning it's a service type, right? It's a revenue type, it's the revenue approach of $5,000 for each on the top. The warranty period is 5 years. Historically, the warranties have resulted in a cost of approximately $500 each per year. They use it the cash basis. What does that mean? So how much have they recorded? What have they done? Tell me what they have done first. They use cash basis. What does that mean? They recognize the whole thing into which account? They're selling it, so which account would they have been included? Everybody knows? Are you guys, do you understand what we're doing here? Tell me what they have done. The question says that this is done on a cash basis, they record on a cash basis, so what have they recorded?
Revenue, cost, and initial buying of the warranties.
So they did record, because they record on a cash basis, so they collect the money that they have sold? How much money have they collected? It's $5,000 each, right? How many did they sell? 100, so how much money did they receive? So how much would they have recognized in their revenue? So they debited, the first entry is they have debited the cash and they credited revenue of 500,000. Is that the right way to do it? For service approach, what are we saying? You cannot recognize the revenue, right, until the warranty period is over. So in this case, the warranty is good for how many years? 5 years. So that means that and what is the period you're dealing with now? What is the period you're dealing with now? What is the period now?
2028.
You're at, so when is the warranty sold? You are not in 2028. It is currently January. What? Take a look at the third paragraph. What year are you in now? Is now when? You are engaged to do what? What are you engaged to do? Maybe I'm picking up an old thing. Is this 2027? I guess. Okay.
2027 year end.
Oh, 2027, okay, I'm looking at the old version of this, okay. So 2027 year end, right?
Yes.
Like, so you're looking at 2027 year end, and then when did you sell those warranties? During 2027, isn't it? So how much of that warranty can you recognize?
1 year.
1 year meaning how much?
100,000.
So what is the implication?
Nothing reversed.
That means that they have now, remember that when you're writing cases, you can use journal entries if you really feel that that's a better way to reflect it. But when you do the journal entries, please do state what the implication of that journal entry means. Don't just explain and say, this is a journal entry they need to do. It doesn't tell me anything. You have to tell me what is the implication of that journal entry. Now, so what we needed to do is we have to reverse, right? $400,000 from revenue, and where would they go?
Unearned.
Unearned revenue would have to be increased by $400,000. So what is the implication? You are increasing a liability by $400,000. You're reducing a profit by $400,000, meaning your debt to equity ratio will be drastically affected, isn't it? Negatively affected. Is that true? Because the key thing here is to do with the debt to equity ratio, right? Your liabilities go up, your profit goes down. That's the worst case scenario, isn't it? Your equity goes down and your liability goes up. That's kind of double whammy, right? In this case, so that means you should explain that would be actually be affecting you. Is that the only thing I need to address in this issue? Is that the only thing I need to address in this issue? Please do not just look at the answers that I put on the board. You need to think. What is that the only issue I need to? Please look at the case again. Look at the case facts and what are the other things you need to address. When you're recognizing revenue, what else do you have to recognize as well?
Liability.
Sorry?
Liability.
Expenses and liabilities. So do I have any expenses I need to recognize? What is the expense I need to recognize?
So 500.
They tell you that to service these warranties, every warranty costs you how much?
500.
$500. That means how long do you have to account for that warranty, for that cost?
500 times 100.
So you have to take 500 times 100. That means you have to account for $50,000 worth of expense as well, right? To match the revenue. So that means you are also understating the expenses by $50,000. And what are you crediting on the other side? So you debit the warranty expense, what would you credit? It would be warranty, you could argue it's warranty liability, but what else do I need to say? It is warranty liability, or does I put here, right? So that means what? You are again further reducing your profit and further increasing your liability, meaning that would also worsen your debt to equity ratio. That's even worse, right? So you have two things you need to address. One thing is you need to shift it $400,000 into unearned. That means that you needed to reduce your income by that amount, and then you also have to increase the liability by that amount. The second thing is that you also have to account for the expenses to support your $100,000 of revenue you are recognizing in the first year. But by doing that expense, right, it's also reducing your income further. So what is my total implication? My total overall equity that I'm actually reducing is $450,000, right? And then my liability is actually a $450,000 increase as well. That's my overall. So you need to account this, you need to address those two issues and talk about what the implication is. Do you understand it? Do you have any questions? Are you able to follow? Are you okay? Any questions? Okay, the next question, what's the next issue? Anybody can tell me what the accounting issue is? They said that they need to perform a cleanup every 10 years. This is December 31st, 2027. And then they said they estimate the cost of the cleanup would be approximately $500,000 in 10 years. Thomas indicated that because the amount is not due for years, there's no need to recognize anything at this point. Is that true?
I believe it's true, because they are still gonna have the, right now they don't have the carry cost, the present carry cost.
Okay, so basically, under the ASPE rules, right, you do have to account for the liabilities for any cleanup, which is the restoration cost. Any cleanup cost, you would have to account for the cleanup cost now, right? As part of the cost of the asset, you have to also include it as part of your liability. It's not like your liability based on the present value of what the obligation is within 10 years' time, whatever it might be. So even though the project has just started, even though the cleanup won't be until another 10 years, they still have to record the liability upfront, isn't it? And what is the amount? How would you do it? You would take the present value of what? Sorry, how much is it? 500,000 over how long? And what is the interest rate that you need to do? Take a look at the question in your required in the back. Did they give you a discount rate? Did they give a discount rate in the required? For this question, under the required, did they give you a discount rate? Or towards the end of the case? Anybody can tell me, oh no, it's actually the second paragraph. Second paragraph, they give you an interest rate they need to use. It's 9%, right? So you can actually do that over 9%. Is that okay? So you need to take a look at the present value of the restoration costs over 9%. So that means you should be accruing $211,205 into your balance sheet. So you should debit the plan for this amount and crediting ARO. But the critical thing here is you're understating your liability by $211,205, right? That means this would again negatively affecting your debt to equity ratio, right? Is that it? Is that everything you wanted to talk about it? If I give you this issue in the exam, is that all you need to talk about it? You should go on and talk about what that implication is. So going forward, right? They would have to account for the accretion expense. They would have to account for the depreciation expense as well. Roughly speaking, those things add up to around $60,000, right? Per year. So that means on an ongoing basis, they would be actually increasing liability, but also increasing the expenses as well, right? So that means that if you take a look at the overall expense going forward, would be interest expense would be $19,000 for the next year, and depreciation expense would be $21,000. I think your argument is going forward, they would on an yearly basis, roughly every year they would have account for $40,000 worth of expenses and $40,000, roughly around half of that amount will go into liability as well, right? So if that's the case, then that means that you're on an ongoing basis, that will still have a negative impact into your debt to equity ratio. Is that true? I'm expecting that you go deeper, so you don't just stop at the whatever you do this year, you have to tell us what the implication is going forward as well. Now, remember, I don't have time to go through every single, like, standard and so on, but when you're writing the case, you have to go to the handbook and pick out the appropriate section, and then make sure that you relate to that appropriate section and discussing the implication, right, accordingly. Is it okay? Let's take a look at the third issue. What's the third issue? They said they bought the inventory on Jan 1st, 2027. The purchase was financed through an interest-free vendor take-back loan. So that means that they were promised to repay $200,000 in 2 years. Okay? So what they recorded is they recorded $200,000 as a loan, and then they also recorded they recorded the loan on the balance at $200,000. So that means, so potentially, how much do they put in the inventory then? This is for the inventory, right? So they didn't repay $200,000, so they recorded the loan as $200,000, and then they said at the end of the year they have a net realizable value of $100,000. So what is the issue? How many issues do we have in this case? Now, sometimes in the exam, for the cases, I would like to actually ask you for the cases that we've taken up as well in the class. So please make sure you understand fully what we're actually working out, because this case is a really good case, because it really captures everything we learned in chapter 13 and 14. So in this issue, how are you gonna address them if I give it to you in the exam? How are you gonna address them? How many issues do we have? How many issues do we have? Yeah,
Then we have two major issues.
what are the two issues?
One at the beginning where we record it, and then each subsequent year there's like nested entries.
Okay, that could be one thing. Let's talk about the first issue first. So how would you be recording it? Now, they did say it's interest-free. Is that really interest-free? So what do you need to do? You remember what we talked about notes payable, right? What did we say? You need to discount them, because they said they promised to pay $200,000. That means that you need to first of all find out what is the proceeds they're actually getting today, right? What does that mean in the value today? Because that would also affect the way you're recording an inventory, isn't it? Yes or no? Because currently they're recording the inventory as $200,000 and the liability is $200,000. That's not correct, isn't it? So how do you account for the inventory value and the loan value then? In today's value. 2 years later, you need to pay out $200,000, meaning what do you have to pay out now? What do you need to do? 2 years later, you need to pay out $200,000. That means what is the value today? So what do you have to do? You have to do the present value calculation based on $200,000. How long is the period? And how much is the interest? 9%. So you have to do a present value calculation to figure out how much they should account for the inventory and how much they should account for the loan, right? So if you do this, that's how much you need to record, right? 168,336. So if this is the case, what happened? That means their liability is overstated right now, right? Is that true? Okay, so that's another thing you need to address. On an ongoing basis, then what happened? They have to account for the interest, right, on their liability, and then you have to account for that, and then you have to account for the liability to go up as well, right, on an ongoing basis. But for now, they have actually over accounted for the liability, right? What's the next thing you want to accrue, what you want to address? So at the end of this year, how much is my inventory worth? At the end of 2027, what happened? You have to account for the interest, right? Yes or no? This is happening at the beginning of the year when you're recording the inventory, and this is the value you should record in the inventory. At the end of that year, why do you need to know the value at the end of that year? Because what did they tell you? well, number one, you are still within that year, right? So do you have to account for the interest? Okay, is everyone knowing what I'm talking about here? It seems that I'm the only one that's excited about this case. Nobody else seems to be interested. Okay, first of all, do we understand what this issue is about? So the issue is they recorded the inventory and the loan at $200,000 upfront, and we said that's wrong, because then that's the value that you should be paying out 2 years later. So in today's environment, you need to recognize the present value of that loan, right? To figure out what the inventory value really is. So the inventory should be 168,336, right? And then the loan should be recorded at 168,336 at the time when this transaction is being set up. Now, you are still within that year, because you're still within that year that you have to account for the transaction. At the end of the year, what do you have to do? You have to accrue the interest. You need to accrue the interest, and this is the entry to record the interest, right? So that means you need to debit the interest expense by 1,050, and then crediting the notes payable for that amount, isn't it? So this is the entry you need to, that means expense is understated, equity is overstated, right? The first entry is positive to them because they overstated the debt. The second entry is affecting both the equity and the debt. Is that okay? So we can look at what the overall net effect is. Then what is the next issue you need to do? How much is the value of the inventory at the end of the period? How do you account for inventory? What is the accounting principle you want to account for the inventory? This is CO1 stuff. And this is again a very common topic on the CFE exam as well. So how do you account for inventory? Nobody remembers? Inventory has been recorded at the lower of cost or net realizable value, right? So what is the net realizable value? Did it tell you what the net realizable value is in the case? So that means what? Your amount should be 168,336, right? But they said at the end of the period, the amount should be 100,000. So what does that mean? You need to write down. Write down meaning it's a loss, right? A loss meaning what? You're reducing the equity again. So what is my total implication? So for the inventory write down, you need to debit the cost of goods sold for 68,336 and write it down the inventory to 68,338. So if you take a look at all these transactions, look at the overall impact, that means that your liability is overstated by 16,514 net, but your equity is overstated by 83,486, right? Are you okay? So is that going to be affecting your debt to equity ratio negatively or positively? This one you subtracted 16,514, and this one you have to reduce that by, how much is the amount? 80 what? 83. Would that be affecting your ratio negatively or positively? Negatively or positively? Negatively, right? Because the base is a lot smaller. That means your debt to equity ratio is going to be higher, isn't it? Is it okay? Because this is the amount that the amount you're taking out here is much smaller than what they're actually taking out here. So your base is a lot smaller than what your numerator is. Then as a result of that, then your debt to equity ratio will be negatively affected again, right? Do you understand the flow? Do you understand what we're doing here? You need, as I said, if you are not clear about what the implication is, do the journal entries. But when you do the journal entry, figure out what the implication is, then come up with the overall implication, then you will see the whole picture. Like what I did here for you. Is it okay? Do you follow this? Do you have any questions? Okay. Let's take a look at the very last issue. I'm not taking up the very, very last issue, but I'll take up the next issue. The next issue is on June 30th, they launched a wrongful dismissal, a suit against the BBE for $150,000. The lawyer indicated they expect a payment of $100,000 to $120,000, but it's still in the court proceedings, assuming the amount is equally likely in both ends. But in this case, because you're using ASPE, so it's not relevant, right? So they're saying to you that they want to recognize any amount, they did not recognize any amount, because BBA would still be able to successfully defend the suit. What do you think you need to do? Sorry? Sorry, I'll go to her first and come to you after.
Yeah, they record a provision.
How much is the provision they should record?
That's good. So lower of the range.
So they record 100,000?
No.
The-
They don't record 100,000.
They don't record anything?
They record 100,000.
They need to accrue 100,000, that's what they're saying, okay? What is the implication?
The implication that by not doing it, they're artificially increasing their liabilities.
So they're understating the liability, so in this case, that they need to increase the liability by $100,000, right? Because what is the indicator that tells you that you need to accrue? What is the indicator in the case? You need to go back to the case, right? What is the indicator that says that you need to accrue? The lawyer expected, right? So that's one thing, you need to follow the lawyer's advice. So that's the reason why you need to overcome it. Okay, so we talked about 4 issues. The 5th issue is tied back to chapter 15, so I'm gonna skip that for now, just to reduce a little bit more confusion for you. But then when you add up all the different implications, right? They're actually going to be, just when I go into the details, so you can calculate yourself by taking a look at all the different changes which I show up in the spreadsheets. You can figure out what the real impact is to the debt to equity ratio, which is what we're expecting you to do in writing the case. When you finish all of those things, you will find that they're either exceeding or they're very close to the bank covenant. So what would you recommend them to do? Now, don't forget, you still have to advise them when the dividend should be distributed, right? Now, how much is the dividend they want to distribute? 800,000, is that a small amount? No, it's a pretty huge amount. So would you recommend it to do it under the circumstances? When you distribute dividend, what is the journal entry? You debit the retained earnings, right? And you'll be crediting either cash or dividends payable, isn't it? Either way, what's gonna happen to your debt to equity ratio is to make it even worse. So in this case, would you recommend them to go ahead and pay out the dividends? That's the first thing you would say. Under the circumstances, they're already breaching the covenants, right? Then you would not definitely recommend them to pay out the dividends at this point. Is that okay? What are the things then you would then go on and say? What is the other recommendation? If writing the case. Is that it? They're breaching the covenant. Is that a serious thing or not a serious thing? You need to warn them, right? So what is the consequence if they're breaching the covenant?
Don't expand.
That's one thing they should do, but what is the consequence? You need to tell them what the consequence is in breaching the covenant, right? What is the consequence? When a company breaches a covenant, is it a small thing or a big thing? It's a huge thing because they can force you into bankruptcy, right? So what do you need to do? The first thing they need to do is to do what?
Do they have funds?
They need to, well, it would be very difficult when they come up with the money immediately, but what they needed to do is they need to go and work with the bank. Remember we talked about working with the bank, coming up with a concession and so kind of thing. You need to negotiate with the bank to see if you can make up some kind of arrangement for them to buy some time, right? To hopefully come up with a resolution to bring more cash into the business. How can they bring more cash? Number one, not expanding. That's one. You should not be expanding right now because you're short of cash. What are the things you should do?
Sell assets.
You should sell assets. If there's any redundant assets, you should sell them. You should scrutinize your financial statement. That's one thing. Anything else? The basic things that you have learned in your CO1 as well. What are the other things? You may want to look into factoring of receivables, right? As an example. Can they do that? Do they need to look into cutting their expenses? Looking into reviewing their operations, cutting expenses? Maybe they need to terminate some employees or whatever, but they might need to drastically find ways to reduce costs, right? You need to come up with that. What I'm trying to say to you is that you don't end a discussion by just saying that, okay, don't pay out the dividend, that's the end of it. You have to tell them that because they're in such a worse situation, they can potentially get into bankruptcy by the bank. So as a result, they really need to come up with this is the action you need to take. Number one, talk to the bank, come up with some understanding. Hopefully they will give you some concession. Number two, they need to come down with a bunch of these other things that we just talked about, right? What's the last thing they should do? If everything else fails, so what should they do in the short term? Just go bankrupt? Is that what you're going to recommend them to do? They will fire you as a consultant right away if that's what you recommend them to do.
Continue your current operations.
To do what?
To not go.
The continued obligation won't give them the money right away. So what do you need to do? We're running out of time, so I'll try to give you the answer. The owners need to dish out more cash, right, into the business. That's the worst case scenario. You have to warn them that you may potentially have to dish out that difference in the short term. Make sense? Or either that or they don't draw any salary. The case didn't tell you whether they're drawing money or not, but you should also indicate the fact that maybe you should not be taking any salaries or any of those things, but in the meantime, you should try to come up with your own personal cash to go. Now remember, when they're in that state, they're not gonna get any financing either, right? Nobody will give them any financing. Are you okay? I used to work for a company, we actually went through exactly the same thing. We actually went through, we breached the covenant, it's a small company, and then the bank actually basically tell us that we have to come back and repay the money. Fortunately, our corporate office at that time, we are public, so we have our corporate office have come out and helped us, so we managed to refinance it through another bank. But in most circumstances, right, you won't be able to get another financing. Very, very difficult. So the owner will have to dish out more money to get it going. Or they either that or they have to use their own personal guarantees to come up with more cash, right, in that regard. So I just want to think about these things in a practical point of view when you're addressing them. Please make sure whatever you recommend is realistic, right, as well. Is that okay? Did I give you a favor? I would recommend you think about this case and writing it up, because in the exam, this the similar type of structure that I would probably ask you. Not exactly the same issue, but the structure may be somewhat similar as well. But take a look at your case assignment and see how that works out too. Okay, so good luck on your case assignment, and I'll see you all next week. Your final, one last thing, sorry. Your final exam is going to be held in class on June the 24th. I just want to make sure you all know. And then the other thing, you will be writing in IC 300 and 302. Okay, so for those people that with last names alphabet A to L, you'll be writing IC 300, and I will put this all in Quarkus. But A to L, you will go to IC 300, and then LM to Z, you'll be writing in IC 302. The exam will start right at 1 o'clock, so please don't be late. You don't have that 10 minutes grace when you write the exam, because I want to give you the full 2 hours to write the exam. The exam is 2 hours, you'll get 2 problems and 1 case. Okay, that will cover everything for the 4 chapters that we cover, right? Is that okay? So we'll talk a little bit more next week. We still have another week before the exam, so next week I think we still have a class. I think next week is a reading week too, right? Is that next week the reading week? Unfortunately, our class doesn't fall to reading week, so we still have a class next week, I guess. Yeah. Okay, have fun everyone. I'll see you all next week. Thank you.